Okay, thank you very much for your patience. I believe we can begin now. First of all, my name is Akim, and I'll be your host for this session of the Business Growth Series. Um, Tonight's topic is one every business owner needs to hear, and that is managing your business for profitability. Whether you are running a small shop, a growing SME, that's small medium enterprise, or you are scaling into new market. Staying profitable, not just busy, is the real goal. And we have put together tonight's session to help you do exactly that. Before we dive in, this session is free, but we are glad you registered. And feel free to drop your questions in the chat as we go. At the end of the session, our guest speaker tonight will address as many as he can. Now, I'm going to say a little about who is hosting you tonight. This webinar is brought to you by Tradiu, and Tradiu is a business operations platform built for small and medium enterprises across Africa. So starting right here in Nigeria, we help business owners simplify the day-to-day chaos of running their businesses. Things like invoicing for your customers, operating and tracking your inventory, keeping proper customer records, your billing, your shipments, even getting real reports. And we also have referral system all in one place. So in short, Tradiu exists so business owners can spend less time on administration and more time actually focusing on the things that can help them grow their business. If that sounds like something you need, you can check us out anytime at tradiu.com. Now let's get right into tonight's main event. Our guest speaker tonight is someone who knows profitability inside and out. She's is a finance business partner with deep experience helping businesses manage their numbers, cut waste, and build sustainable growth. Please join me in welcoming tonight's guest speaker, Tosin Lawuyi. So, Tosin, over to you.
Um, hello, everyone. Think probably we might need to invite more people to the call. Uh, just want to send reminders for it. But yeah. I've also requested sharing. You can accept that.
Okay.
What?
Okay, you can go ahead now.
Okay. All right. Good evening, everyone. My name is Tosin Lawuyi. As the host already said, a finance business partner. I do I do work with a lot of businesses here in the UK, right, from retail to hospitality. But before then, I had the opportunity to work with a bank in Nigeria and also with a thank you, Domin. But also with a global firm in the name of USC before I finally moved out of the country. So I knew a few things around FMCG, around investment management, around banking, around finance, around fintech, retail hospitality. And also, like when I moved, also had the privilege again, right, to work with Lloyd's um, as one of their private equity mm, member. Where I worked on like two big deals, right, which are currently live, one in medical and another one in education. But yeah, all of that just a bit intro about myself. Um, when I'm not busy, what am I doing? I think I'm enjoying love of my life. Time of my life, I don't play football. Can be a ref, but I don't play, and every other thing is fine. But basically, like tonight, I think like what is most important for everyone that's going to view this at any point in time is, and then I'm to share my screen so that this brings it home to everyone. All right. Please confirm you can see my screen. Oh yeah, I think I'm probably showing the wrong thing. Okay, give me a minute. That's more for the creep. Machine desktop. Okay. This is for safe for people that use this kind of device. Alright, please confirm what you can see.
We can see your screen.
What can you see?
Managing a business
Okay,
for
yeah.
profitability.
I'm trying to put into slideshow now. Can you see that also?
Yes, yes, yes.
All right, thank you. Um, so as we begin tonight, right, the most important thing in this entire conversation is there are some of the gaps I've seen over time in businesses that are basically fundamental, and I wonder why people do not just get it. I guess it's because I've worked all across the sectors, right, and I've seen how people think, um, and I think it's them seeing finance as an obstacle rather than a helpmate, right? And that's why like a finance business partner role is a very important one because beyond just providing you what was done in the previous month, right? The reports and whatnot. What is important in this entire conversation is how do finance guys help businesses to meet their goals, right? And that's where I come in. That's what I do in my day to day. And I'm going to share some of these things with you guys. Right, as I said earlier on, my name is Tosin Lawuyi. I basically like read business the way an investor does, right? I understand what cash means, what margin makes, risk, profitability, limits, right? Assets, what does cash flow means, what does being able to understand your unit economics, right? And there you have it, yeah. A bit of USC, a bit of Lloyd's Bank, and I'm currently working at Glecos. All right. So in our conversation tonight, we're going to be discussing three things, three fundamental things, right? One is the growth trap. The second one is the inflation tax. And the last one is like profitable but broke, right? So, in order to make this exciting for everybody, this is I have two things to say. Number one is if you can turn on your video, please turn it on because I need to see reactions. I need to know that you're following me, which is one. Number two is I'm going to be asking questions and I need people. So I'm going to call people at random, right? And I need to know what you think about these things. So once I call your name, tell me what you do, and they let me know what you think is the answer. All right. So Tommy, you're my easiest pick because you've been on this call since we joined. So Tommy, Tommy, say I.
Hi, sorry, it's raining over here. I don't know if you can hear me.
I can hear you. I can hear you. So, um, if you have two businesses, right, where one is growing, one moved from in a year, one moved from 10,000 to 15,000, and another one moved from 5,000 to 10,000. However, the one that moved to 15,000, you only made 2,000 as profits. And the one that moved from 5,000 to 10,000, you made 4,000 as profits. Which one are you most likely going to go for? Which kind of business will you consider sustainable?
If I heard you clearly, you said the second one had like, is it 4 or 5,000 naira profits compared to the other one?
Yeah.
I think I would consider the second one more sustainable
Why? Why
because
is, why
of the
is
profit margin.
so that means when it comes to growth, so that means when it comes to businesses, margin is more important than what the revenue growth is.
I'm not sure. I don't know. I just said
Okay.
what I thought.
Yeah. So I get it somewhere, right? So fundamentally, right, and then everyone, please work with me. Your business is doing so well. When it comes to revenue, you are growing as fast as you can, speedily, rapidly, whatever the terminology you want to use to describe growth is. However, your profit is as little as you can get. You're literally making peanuts from it. 5%, 10%, right? There's another business. It's not growing as fast as the other one, but you earn more profit from it. So regardless of whatever you think about the growth of your other business or the first business, you will choose the second one because the second one offers you more in terms of profits. Right. So I'm going to show you something in the next slide. We'll come back to this. Right. And that's basically what you see here. And it's a real story that happened. Without calling names, right? So there used to be this large chain business, right? And everything was going on well. We were making money, good money. We were growing as fast as we can. Or we should, based on the expectations of management or the directors, and of everybody that was interested in the business. We expanded the stores from 15 to 30 in literally 1 year, right? So instead of 4 years, we had moved from zero to 30, right? Um, However, we were more profitable when we were 15 stores than when we were 30 stores. And the simple reasons are the more you grow a business, the more you want to like increase certain costs. When it comes to costs, there are two important things. There's the fixed cost, there's the variable one. For the fixed cost, everybody knows what to do with it. For example, your rent is 1.5 million naira. Yeah, that's good, that's for fine. All right. But when it comes to like variable cost, that means the cost that changes as you improve or as you that you decline or increase, right? And then you get into this space and then you realize that things like diesel are going to increase, like that's going to increase. And unluckily for the business, diesel moved from 2,000 to 1,000 per liter then. So that was the first blow. Electricity became bad. Inflation kicked in. So while the revenue was growing rapidly, gross margin had moved from 24% to 16%. So, in simple maths, for every 100 naira that we made, before we used to take home 24 naira. Now we're taking home 16 naira. So, irrespective of how exciting the growth is, never forget your profits, your margin is more important than however your growth is, or whatever your growth is. Again, I'm going to repeat this. Your margin, which is basically what you sell minus your cost, what is remaining. That figure is important than whatever you are earning or your growth rate is. So, just something for you to understand, which is not all revenue is equal. And that's another thing entirely. So you can have two products, right? And I'm gonna give example of something that probably most people don't know. When it comes to Amazon, for example, Amazon's money is made from cloud services and not from the fact that they are into logistics. Okay. Because people know them as a logistic company, their volume, their awareness, their publicity comes from the fact that they are well known as a logistics company that make sure that you get wherever you need to get. They are the online delivery partner, all those sweet names that you have of them. But you know their sweet spots is the fact that they can provide cloud services, the Amazon Web Services, AWS. That's exactly where the money is. And the same thing for everything that you can think of in this life, right? You can bring it down to every single item that you do. So if you're a company that sells food, what you made from rice is going to be different from what you make from beans. What you make from spag is going to be different from what you made from your swallow. So you must fundamentally understand what is the margin per the item. That's what I'm trying to drive at. Which one actually makes you money? Which one drains you? Which one brings you the brand awareness? Which one gives you the volume? Which one is the most profitable? The most profitable one is the most important one. It doesn't matter how exciting the other part is. What keeps you alive as a business is understanding what is the most profitable item that you have in your business. And now you can increase the sale of that profitable item. Again, growth is not bad. It's just not the goal. Profitability growth, profitable growth is profitable growth is like what you're choosing as your goal should be how profitable am I with my growth. All right, so I'm picking on Peju next. Hi Peju, how are you doing?
Sorry. Hi.
Hello, what do you do? I know, yeah, I know who you are. I know who you are. Why are you for the audience, right?
Okay, my name is Ola, and I'm currently a business management student, but I have some businesses as well that I run in Nigeria.
All right. Um, have you ever experienced the effect of inflation?
Um, Personally, or in my business, I think I have,
Okay.
because there was a time I used to do personal shopping, and that was in Nigeria. That was before lockdown and after lockdown. So I can say that inflation sort of like affected my charges in some way because cost of items I was buying went up, and then I was charging percentage, so it's kind of influenced how much I needed to increase how much I was charging, and then it wasn't okay with my price. So I think I have experienced inflation before.
Okay. So how did you How did you solve inflation? How did you navigate that phase?
Okay, so before the inflation, I was charging percentage a fixed percentage across board. So what I mean is that if I was shopping for you and I was to shop for an item of over 100K, I was charging the same percentage as if the item was below 10K. So when the inflation happened, what I did was I grouped the fees, like for instance from 10K below, I'll charge maybe 10%, and as the amount grew, I reduced the percentage just to accommodate, like just to make the person who is buying a lot more
Yeah.
understand that they're not necessarily paying more in that sense. Or they're not paying the same thing as with someone that is, someone that is paying less than 10K, something like that. I don't know if you get what I mean.
Yeah, I get what you mean. So you mean that you were charging different prices initially, or just
Yes,
same price,
10%.
but now
Yes.
different prices for different items
Yes, yes. So
instead of
if
just
you're
one.
like 100K above, I'll charge maybe 10%, and then if you're like maybe 10K, maybe 3%, something like that, just to make everybody comfortable with how much you're paying. The way thing.
Okay, okay. That makes a lot of sense. That makes a lot of sense. I think at this point I'm going to tell you a story that but this is recorded. I think I'm fine. I think I can say this some of these stories. Right. Okay. So I used to work for this again, probably because if you check my intro, you probably know the company I'm talking about now. So I used to work for this FMCG company, right? And there's a particular brand that everybody knows, right? Um again it's recorded, so I can't call brand names. So this popular snack that everybody eats. And when I joined the company, it was a tough time. It was shortly after the entire pandemic, and so it was post the pandemic, right? And these items we sell for 15 naira. This item I've been selling for 15 naira since I was born. Like I grew up to know that this item was always sell for 15 naira, right? Not when I was born. I think I was being older, but get the drift, right? And so it's usually like you buy that snack for 15 naira, then you buy the drink, another drink for 15 naira, then it's 100 naira. Right. If you're a big boy, then you can buy two of the snacks and then one drink, and then that makes it 150 naira. When I entered, and because of like the rise in inflation and also the pressure from like exchange rate and all, we're making less than can we do like a 4% on every CO, right? And that meant that the business in itself was not sustainable because if at the end of the day, as big as we are, if my gross margin is just 4% and I still have stuff to pay and I still have leases to pay, I still have my interest that I collected from the bank to pay, how will I pay all those things? So at the end of the day, we knew one thing, we were going to like improve this price. However, the first time we tried to improve the price from 15 naira to 100 naira, it backfired because nobody buys this item for 100 naira. Everybody knows to buy it for like 15 naira. And then we went ahead to say, okay, let us change the dynamic. Let's reduce the content of this snack. So reduce the content, right? Yeah, publicly saying that we did that. We reduced the item of this snack, and what then happened was that people moved to the competitors, right? So there was this popular competitor. There was also gaining ground then, and because they had more feeling for their own snack, people move on to them. So we had to remedy the entire situation and say, no, we can't do that. Then when I had to change the nylon, I think this one most people remember, right? Because at that point in time, people started flagging it on Twitter and the rest. They say like, oh, the nylon of this is not, it's not as thick as it used to be. But of course, we wanted to like increase the margin, right? As I told you earlier on, increase the margin of the business to make it more profitable for us. That also did not work. So what we eventually did was to release two variants of that same product in the market. One was 15 naira, and then another one was 100 naira. The 15 naira one, what we did was as simple as No, the ordinary one rather. For the ordinary one, what we did was it was 2x, so it was 2.5 of the 15 naira one. So that means if you buy the ordinary one, you have two of the 15 naira one plus an extra 0.5. So it's bigger, it's longer than what you have. So it's beneficial for you to buy the ordinary one than to buy the 15 naira one. Because if you buy two of the 15 naira one, it's not up to 100 naira one. So eventually, people are discovering that 29 was more important, right? It was more filling, was had more tasted better and all of those things. And we eventually moved customer behavior from the 15 naira to 100 naira. And people started, even the retailers, the marketers started like getting like the 100 naira one. And with time, we reduced the production of the 15 naira one to eventually like wiped it away. And we left 100 naira as it were. I've seen all of this in like in a country like Nigeria or anywhere in the world, right? Because even in the UK or wherever in the world, there's this surge, right, in terms of cost, right? And that's basically because of inflation. What is most important to business is to understand what is my unit economics. How much am I making on every sale? If unit economics is very simple. If I have only one item to sell, how much am I making on that one item? Does it pay me? Would it be better for me to sell 10 of this item at once? As others rightly said, right? And then charge a better price for that. If I'm going to charge for one, will it be more, right? So if you're buying bulk, you pay less. But if you're buying a single one, you pay more. All of this goes into inflation tax. As you can see from this particular this slide I can show you, is the cost is the one in orange. The price is the one in black. If your business is like this, where your cost is higher than your price, there's a problem. In this particular business, it was 36 points gap. So for an item was that we're selling at 100 naira, the cost was 136. So you're losing 36 naira on every item. And that brings me to this. What is most important when it comes to pricing? So margin is your pricing. What is most important when it comes to your margin is your pricing. My people, everyone listen to me. You cannot be more profitable because you sell more items. You can't say, well, I want to make more money today and I'm going to sell 1,000 pieces of this item. No. What it does is that it increases your value, but it does not increase your unit economics. It does not increase your margin. And it doesn't increase your margin, it's as little to no effort. Get me right. It's good to increase, it's good to make more money. It's good to sell more. But what is more important is that on every sale, are you actually making money or not? Because I've seen people, I worked in organizations, I worked with, I think most people are guilty of this, are people that are working like maybe startups, right? Sell more items, go and find sales, but they're offering everything at free. So everything is free to the end. If you continue to do that, it will lead to one thing. Yes, you have more users. Yes, you have more transactions. Yes, you have whatever it is called. But the bottom line is you're not making money. And what is a business if not making money? It's an NGO. Right. So pricing is first about the cost price per item. Always know your numbers. If you don't know your numbers, you are doing yourself a great disservice. Know your numbers. Know your numbers. Know your numbers. Know your numbers. Know the highest and the biggest mover. Know your numbers. Be more deliberate about your pricing. Pricing is not something you put on your calendar and say, I will come back to it at the end of the month. No. It's something that you monitor. It's something that you know what is your cost, right? And you know what can trigger your cost, right? So, for example, when there was the war between Ukraine and Russia, that implication on certain items in the Nigerian market. You have to know what is going to happen. You can't say, oh, they are far away in Europe, it does not concern you. No. So if you're selling maize at that point in time, you have to know how does this affect the price of maize. So that gives us that perspective, right? And then lastly, which is about the story that I told you, understand price elasticity. It's very simple. Price elasticity is how much you can stress a customer or stretch a customer, right? So people that will not pay more than a certain price for your products. If you don't learn that very fast and you don't know what that mark is, you will have a good product, you have everything good customer service, good everything, but it's just way too pricey. So know your audience, know what is the max they can pay for this item. Either via survey, either via testing, going back into the market to actually test, whatever you need to do to ascertain this is the mark at which the customers will not go beyond. You need to know it. I need to know where to introduce a change in price. So there are different elasticity. If you sell an item in the airport, it's different from when you're selling it in like the regular market. You can be bit more pricing at the airport. Know when to change the price. If you change your price, for example, during for a product, if you change it during Christmas time, you probably still make more money because people are excited and people have enough cash with them to buy. If you change your price in January, just be ready that somebody's going to like you're going to churn, literally. Know what to change in pricing. You don't have to change everything. Know which particular item you're going to change. And then know how to communicate that. How is very important. How we are going to introduce that change in price. Right. So for the last lesson for today, Samuel. Hi, Samuel. So it's not. Hey, it's okay. Hi, Samuel.
Sorry, I actually came a bit late, so I didn't even get to.
I'm just calling your name first. I've not even asked my questions yet.
Oh, okay.
Okay. But can you be more audible?
Okay, so I just joined the meeting. Joined in like a bit late, so I didn't really get a full brunt of it.
No, no problem. You will
So,
catch up. I promise you.
all
So
right, thank
I
you.
just have one question to ask you.
Okay,
Will you choose to be profitable, but broke, or you have cash but not profitable?
interesting.
Which one you go for? Profitable or cash? Profitable or money? Profitable or liquidity?
I mean, why am I profitable? What is this profitability? It is not cash. Is it that I just have a good number of customers, or I'm gaining value something somewhere else?
So what do you think is it? Let me trace back at you. Why do you think there are companies that are profitable but broke?
Maybe they're broke because of maybe poor management choices. Maybe they get into bankruptcy, so they don't manage their funds properly, or they have poor teams that manage maybe operations, things like that. But they could still be profitable because they have high yielding customers that I mean can prove or can validate like the business and that the business is profitable, but then maybe their structure is just wrong. So it's going to be very difficult for you to be profitable. Yeah, it's going to be very difficult for you to be profitable and not make money. Because if you're profitable, it means that you are gaining something, say a value,
Yeah.
or you have the potential to create value.
Okay. Yeah. So thank you, Samuel.
Thank you.
As simple
Thanks, thanks for
as simple.
putting me on the spot, by the way.
You're welcome. Sorry about that, but yeah, I mean it's part of the lesson. So And this one it's like because this has happened to me at least 3 times in my entire career. So I think I'm probably one of those people that can tell you a little story about you can be profitable but broke. And I'm going to give like three for those 3 times that I've been in this situation, I'm going to give you like three different things that happened, right? So the first thing that happened was we were making good money, but we were selling on credit. As simple as that. Right. So good for us. We did have plenty customers, right? But the top five were the most important. So the way we say it is like top five were contributing 65% of our revenue. However, those top five will not pay you on time. So which means that 65% of our revenue were delayed. So even though we were making sales, we had at least customer that we could sell our products to. But the biggest issue there, very simple. Money was not coming in. So if you're an accountant, you know that, oh yeah, in your profit and loss statement, you just put revenue, slam the amount. Good. In your cash flow statement, you just be seeing zero, zero, negative, negative, people owing you. You're seeing debtors everywhere. And you're wondering what is going on. And it's as simple as your creditors are there owing you, rather, and your debtors too are there owing you. And then there's you that is just saying on your profit and loss statement saying you've made sale. So that will lead me to like the first thing I'm going to say. Like the first lesson I'm going to say in for this part three is understand what your working capital cycle is. How much, when is my money coming in? When is my money going out? I feel like this is a masterclass in itself. Understand when. When is about time if you're all good student of English, right? I don't mean value. I mean when. Time. Understand the time your money comes in. Understand when your money goes out. For example, if you handle payroll for your company, you will definitely know that no money goes out unless it has landed into your bank account first. So between the time that you make a sale and the time that you service your payroll, what does that look like? So, which means that if a company that sells products, if I do I need to do from day five, and I know that my money must come in before day 25 because I know that I will pay my employees by day 26. So when you're negotiating terms, you don't say pay me by the end of the month to that business that you're selling on credit to. Because once you do that, you've given yourself a burden to go and find the money somewhere else to cater for your inability to say no, pay me by day 15. So if there's any gap that lasts to day 20, from day 20, you're able to manage yourself up to that point in time. Guys, everyone, timing is important when it comes to money. Not value, not volume, time. You can have all the money in the world. If it's not coming at the right time,
Yeah.
it's
I
not
want to
really
do it
gonna
in
matter. Yeah, it doesn't matter how good the money you are making is. If it's coming at the wrong time, you're going to make a loss. So basically, the way the cycle works is my receivables must come in earlier. Receivables is like people are owing me, must pay me faster than paying other people. If I have somebody supplies me the raw materials, I must give them a later date compared to the dates that my own customers are paying me. The customers are going to pay me day 15. I must tell my supplier that I'm going to pay them day 20. That is the best way. You know what I discovered over time is that people just choose running a random dates and then they go ahead to go and borrow money. You now go borrow money with an interest. And what then happens is that when you borrow money on interest, you are cutting your profits, because the money that you are taking over the end of the day, you are not going to use that to pay back the interest on the loan that you've taken. So, in order to reduce your interest expense, in order to reduce the amount that you pay on the interest on your loan, it's preferable for you to have a positive working capital, which means that the money others are owing you or people are owing you must come in faster than the day they are paying other people, their suppliers or even your employees. So in this particular case, that what happened. 75-day debtor terms. See the money that is tied down, 411 million out of 2 billion annual revenue. I've gone ahead to go and take financing cost is basically interest. Now I've gone ahead to take 109 million. Obviously, guessing that I'm using real figures at this point. And that literally happened. And you're like, why is somebody owing me for this number of days? First one going to owe me for 75 days. And then when that switched to 45 days, see how much I'm not paying on interest. 65 million. See how much I've freed 44 million. So which means that I have 44 million now as extra profit. Just because I've reduced the number of days. Let me speed up so I know I've just that. All right. Cash discipline freed free capital. 45-day payment terms enforced on the top 20 customers by revenue. Know the customers that drive your business. Know the customers that drive your business. If you have to write them down, you have to call them every day. You have to know who they are, know what they are doing, know where they're going to pay you, know everything about them. And do this because these are people that will guarantee there's going to be money in your pocket or not. So number two of two things. I told you number one, what basically I was telling you was like, number one is I sell things, but I sell them on credit. Number two thing is, I think that's what Joshua Samuel said rather. But basically poor decisions by management, right? And it's as simple as you want to run a factory. So you set up a factory, right? And then you go ahead to take the money from your profits, right? You went ahead to do everything that you need to do. You set up the factory. The factory will probably not go live for the next 12 months because of several things that you have to do to make sure that it goes live, right? Now you've tied down cash into the factory. It's not generating any money yet. All your profit has gone into it. And then suddenly there's an increase in cost. Fuel has moved from whatever it was, has increased by 5x. There are employees that you have to pay because there are people that have to work on the factory. And before even the factory goes live, you still have to pay those people. Your variable cost has increased. You are less profitable. However, you are profitable. However, you are now broke because you've tied down cash. This brings me to the fact that when somebody says go and prepare a financial model, it's not just for an investor alone. It's not just for an outsider alone. It's for you. You have to understand the implication of what you're trying to do when you want to do it. When you're setting up a business, if you're not going to make money from day one, understand the implication of you not making money from day one. If it's a software business, understand that if this thing takes me 12 months, what is the cost of that 12 months? You have to understand that cost. Because when you tie down cash that is not making you money, it means that you have to go and source the money from somewhere else. You have to know the cost of you sourcing that money. And you have to know when you eventually go live, how long will it take you to pay back that money is important. So cash flow forecasting or a financial model is important. If you don't have an accountant in your life or a finance person in your life, find one for your business, but by all means necessary, get one. Speak to them. Don't write your numbers from your financial partner, from your finance business partner. Don't write your numbers because Probably they're the best person to like let you know if you're going astray or not. And the last part of all of this is taking out profits too early. Right. So I've seen some people, right, because you have two businesses. So you're taking the profit from one. This reminds, this is giving you back memory. Taking money from one to finance the other one without leaving any form of cash for the first one. Now, the second one has not gone live. Second business is not generating revenue yet, but you've taken the money from the first one into it. I mean, but that case I can give to this, I can call names because for this one I can call names is Dangote Refinery, for example. One of the biggest issue Dangote had at the very beginning of Dangote Refinery was the fact that all the money that's taken from other subsidiaries of Dangote, from Dangote Cement and the rest, the Dangote Refinery was not making the money. So at the point where you could not take it anymore, you had to like say, guys, government, alpha, I need to go live. I need to make money. Because the money that could have used for like that belongs to other businesses, I've taken those cash and I put it into this refinery. This refinery must go live. And it must go live this month. Right. And that's why you see all the go back and forth and everything that was happening. In short, is when you are not quite sure of what is going to be the outcome of the other business, do not take profit early, either for dividend sake or for investing in other things aside from the business. Don't do that. Always leave liquidity in the business. This is also to say, like, do not eat your cake. Do not all of your cake. You made 250,000 this month. You've already spent all the 250,000 because it's your profit. Do not do that. Please, please. Don't make a certain amount this month and you think that you're gonna splurge that money. Please, no, no. Your profit does not mean that it's time for you to share. There's a difference between profits and dividends. Dividends is what you share. You don't share your profits. You share part of your profits, which is called your dividends. You only share that when even you are quite sure that it's necessary for you to do that. Don't eat it on fingers. Don't eat all your cake. Don't do certain things. In bottom line is profits and opinion. Cash is a fact. The only thing that makes a business survive is the fact that there's money in it. Doesn't matter if you make all the sales in the mud. Doesn't matter if you are doing 10 things with your money, building 10 factories with your money. Doesn't matter if you've taken profits over time. What's most important to the business is the fact that there's cash available. There's cash available. There's cash available. A business will continue to survive as long as there's money in the business. I'm just going to jump this and move on to that. Basically, the takeaways from here. Every business is as good as its margins. A quick recap for everyone that just joined. This is your revenue growth. Your revenue growth, if you're growing 20%, 30%, 40% is good. But what is important is that at the end of the day, are you making profits? Is your profits also growing as your revenue is also growing? If not, you're doing yourself a disservice. Number two, pricing is beyond this is what my competitor charges. Pricing is first about what is my cost? What is my cost? That's where pricing starts from. Your competitor can have a lot of integration added to the system that makes theirs cheaper. It doesn't mean that yours will be cheaper. The competitor might be more pricey because they don't have the kind of leverage that you do. So yours then is cheaper. Samsung and iPhone are in the same markets, and Apple are in the same markets. They don't sell their phones at the same price. They don't sell the laptops at the same price. One screen is more expensive than the other, even though the full body of one is price is pricier than the other. Understand your pricing starts from this is my cost, not this is what my competitor charges. And then the last thing is cash management is what keeps the business alive. If you can manage your cash, you will stay alive as long as you want. But if you don't, we'll add it to the list of the businesses that don't survive year 1 or year 5. Track your costs, review your pricing, protect your margin, review your prices, protect your margin, manage your costs. Thank you, everyone. That's all I have to say for today's webinar. Questions, comments, feedback. I'm happy to take them all. Over to you, the host.
Okay, thank you very much, Mr. Tosin Lawuyi. And we've now got into the question and answer session. If nobody is raising hands, I'll start calling people. Okay, the first on our list is Joshua. Do you have any question for us? Okay. Second is Olapeju Babalola. Do you have any question for us? Olawani, do you have any question for us? Samuel and Tommy, do you have any question for us? Okay, I have a question. I have a question. And the question is this. A lot of business owners confuse being busy with being profitable. I mean, they are making sales, but still struggling at the end of the month. From your experience, what is usually the real cause of that gap, Mr. Atusi?
Do you mind saying the question again?
Huh?
Do you mind saying the question again? Just say it again. Sorry.
Okay, a lot of business owners
Yeah.
confuse being busy with being profitable. They are making sales, but still struggling at the end of the month. From your experience, what is usually the real cause of that gap?
To be honest, I think that gap is what Tradiu is trying to solve. And I mean, this is past me selling Tradiu, but this is something like letting people know that the fact that your report reveals who you are, right? There's this popular saying that we say in the Christian circle, right? Is the fact that what reveals your intention is your bank statement, right? Yeah, I can share this, right? What reveals your intention is your bank statement. It reveals who you are. What reveals a business is also the statement. It doesn't matter how busy you are. When it comes to, let me give you an example, you're speaking to your directors. Nobody really cares that you've been busy. For example, nobody cares that you've responded to all the emails in this world. If it's not generating money, if it's not generating value, if it's not generating returns for the directors, it's as good. And what you present to the directors, reports, literally, what you present to them is report. So the report is the most important thing. And that is where, for example, Tradiu comes in, where you can generate your monthly reports. You're able to see what you're spending your money on, and then that gives you like an overview of what your profit is at the end of the month.
Okay.
Why people confuse business and let me say creating value in itself, right? Is the fact that we think everything that we do is important to the business. And then that brings it to like the whole 80/20 principle, right? The Pareto principle, which basically is like what actually does the work is the 20%. What everybody lynch on is the 80%, right? Solve the 20%. They are the hardest ones. They are the major blockers. Solve those ones. When you solve those ones, you can go back to the 80% later on. And also, this is one thing that my manager told me when I was slacking on work one time. It was like 3 or 4 years ago. It was like work expands to fit the time. Was it that way or the other way? Time expands to fit the work. I'm trying to put it the right way. That work. Yeah, work expands to fill the time, right? And basically what I was trying to say is basically is you just wanted to do it in the next 5 minutes. And you think like you can like if you have I don't know if it has happened to you, maybe as a student, your deadline is 4 p.m. and you start your work by 2 p.m. In your head, you know that between that 2 and 4 p.m. you will complete that task. But the more you say I have time, the more also we say there is time. So you continue to wait and wait and wait and wait. So as a business person, as a manager, as an operator, always understand you don't have time. If you're paying salary, you always know that there's no time because from day one, you know that by day stop by 26, 27, or 28, you're going to pay. So all you have is like literally like 26 days before the next payment. You don't have that time. Don't confuse business. If it's not giving you returns, returns that is visible to your reports that you will generate to your stakeholders, let it go or outsource it. But don't spend your time wasting your energy on things that do not move the needle.
Okay. Thank you very much, Mr. Tosin. One last one. I'm pretty very curious about this. And it is like for those of us that are running or growing small business without a finance team, what
Yeah.
are what are one or two numbers we should be checking every single week to stay on top of profitability?
Mm, good question. This is a very good question. Number one thing that you need to, I'm going to tell you 5 things that you need to check every single week. Number one, how much did I make? Number two, how much did it cost me to make that money? Number three, what is my profit? Number four, how much do I have? I mean cash.
Mm.
Number five is, and I'm going to, is what is the worth of the business? At every point in time, you're generating any reports. I can give you a simple, I mean, there are simple ways to check this. So, for example, revenue. To be honest, again, if you use Tradiu, right, you see this in one single swap, right? Just one single download, you just see your report. And basically, it's revenue. I think that's easy for most people to track. How much did I, like, okay, I made sales this week. What does that look like? Number two is the people I had to pay for me to make those sales, the supplier, the item I need to buy, how much is the total for that? Very important. Number three, if I subtract number one from number two, I will know what number three is because it started tells me this is my revenue, this is my cost, and then that's my profit. My cash is very simple. Just open your bank statement, log into your app. Again, if you use Trading, for example, you know where your money is. By the time you open the dashboard, you're like, oh yeah, this is just log into your or you use your like your any other mobile app that you use for your banking app that you use. Once you open it, you just say, this is my money. This is what I have left. And number four is what is the worth of your business? If you are confused about what the worth of your business is, just look at your assets and see how much is the total asset I have. Start from there. Like the other things that we can look at, the liability and everything. But for start, how much do I own in all of these things I'm doing? If you check my inventory, so for example, it's a physical product. If I check my inventory, how much is that worth of that goods I see have in my store? If it's software, what does the pricing of this software looks like in the modern market? If I'm going to sell this software to somebody else, what will that look like today? So basically, what we're trying to imagine when it comes to like the value of your business is that you're looking into the fact that what do I own in this business? Is it totally mine, or am I paying somebody else for what I used to make money? But you can track that weekly, monthly, you can buy monthly, quarterly, half year, full year, every 5 years, every 3 years. It's as simple as you can get. Um, Let me see. Okay, yeah. Thank you so much, Olakoju. Oh
Okay.
yeah.
Okay.
And yeah. Any other question before? I know we're out of time already. So
Okay. Any question, please, before we call it a night? Okay, so that brings us to the end of tonight's session. Tosin, thank you so much for the practical, no fluff insight on managing profitability. I know a lot of people in this room are walking away with something they can apply this week, especially me. So to everyone who joined us tonight, thank you for your time. And also remember, this is the Business Growth Series, and we will be back with more sessions like this to help you run and grow your business better. And if what we talked about tonight, which is profitability, better financial management, staying on top of your business, if these things resonated with you, that is exactly what Tradiu was built to support, from invoicing to inventory to reporting to international payments with Tradiu. Oh, excuse me, that one is still on the way. To shipping, to managing your billings. You want to pay your staff, you want to pay your suppliers, you want to track how many people are owing you. Like Mr. Tosin already said, you have to give a day to your debtors so that you can meet up with your own cost. So Trading can really help you with that. So you can check us anytime, you can check us out anytime at tradiu.com and keep an eye out for our page for the next session in the series, or you can be checking our mails, or you can join our Telegram community. I've dropped the link in the chat. Join us so that you don't miss out on sessions like this. Good night, and here's to a more profitable business. Thank you very much once again.